We interrupt your normal programming.
My name is Hugh Hendry, and I ran a global macro hedge fund for 15 years. It was unique, and typically it found itself at odds with popular opinion. This is an exclusive insight into my journey, what I did, and more importantly, why. And I promise you, it's not what you're expecting.
Welcome, everybody, to Confessions with Hugh Hendry and me, Chris Sweeney. This is part number 9. We are working our way through the interesting, dark, zany mind of the hedge fund manager, Hugh Hendry, as I've just mentioned. And we're going through his Eclectica Fund. And today, we're up to the months of June and July. But before we get into that, let's just check in with our superstar, our rock star. How are we, Hugh?
Sometimes I think I've joined the wrong Zoom call when I listen to you, Chris. But I'm very well, thank you. I'm sitting in my favorite cafe
in St. Barts.
In St. Barts, and I was sitting outside the other day, and this dear lady, she came up and she sat down. She was French, and she was saying, "I have a bet with my husband." I was like, "Oh, here we go." I was like, "Listen, I don't do threesomes. I gave that up a long time ago." And she said, "No." She didn't really get my humor. She's like, "No. Can I ask, are you Bono?" And so the fake Bono continues. There is no escape. I am tormented. I've been put on this earth to play the role of a lookalike, and I'm not even a lookalike. So there you go. That was the highlight of my week, or the low light.
Haven't you, saying that, haven't you met Bono or came across Bono in St. Barts? Didn't you end up eating next to him or something like that? Isn't there a little nugget of you and Bono's paths crossing?
I mean, we have crossed. We've crossed. Believe me, I do not exist in this world, but our worlds cross over. I think he's got a big place near Saint-Paul-de-Vence in the south of France, just out in the hills above Nice, and it's the most beautiful place. There's a hotel called Le Colombe d'Or, and I have to say it's one of arguably the most special restaurant for me in the world, and it attracts people like Bono. He has a house there, so I certainly crossed paths with him. Would you believe the last time I saw him there, he was with Richard of Richard and Judy fame, which didn't really make a lot of sense, but good luck to them.
Yeah, for anyone not in the UK, Richard is like sort of you're very sort of. I mean, he's a decent TV host, but he's a little bit cheesy, a little bit. He's not what you imagine Bono hanging out with. Let's put it that way, isn't it? He's not quite exactly what you imagine. Yeah, he also runs a book club, very successful book club as well. Strangely enough, but anyway.
Well said. But he frequents St. Barts, typically on the super like real superstars like that. They live their life hiding. So he hides on a big yacht, but when he comes on land, I certainly see him. Not the last time, but I recall the French Elvis, Johnny Hallyday, who sadly passed away at the end of, I want to say, 2018. But he had an affinity with the island, and in France, literally, he is Elvis, the French Elvis, and he's buried on the island. And Bono, from time to time on the anniversary of his death, comes to the graveyard. The graveyard now is like Disneyland for French Elvis fans. It's a grotto of the absurd, and Bono can be found. If you check his Instagram, he made a video singing tribute to Johnny, one of Johnny's big hits.
Right.
There you go.
And while we're on such celebrity stories, I know you hate me bringing it up, but you do live next door to Roman Abramovich. Now, what I was thinking was, during this pandemic, have you had to take any Amazon packages in for Roman? I'm just curious. You know, I just do something like that. You know, I mean, I wonder if what's that guy order off Amazon? I'm curious. You know, I mean, he must order something off Amazon. No packages.
He's. Oh, I'm not even going to make a joke of it. So, Roman Abramovich technically could be perceived as one of my neighbors. However, he has. Actually, as I look at the harbour, he has more than one astonishing piece of kit floating in the sea, which is to say that when he is here, he spends his time, again, hidden and out of sight on the incredible yacht that he owns. Can't even remember its name now.
Eclipse, no?
Eclipse, yeah. And then there are two, the Grand Bleu, which was his. It's like a $350 million boat, but he gave it to his buddy, Eugene. And they're all out there glistening. There's a boat, doesn't belong to them, it's another Russian, which looks, the front of it either looks like a submarine or it looks like the front of a 747. It's quite ugly, but it's enormous. So, yes, technically neighbors. Abramovich, I've got to say, with the most discreet and professional and I'm sure terrifying bodyguards. But he looks as, when you see him on land on a scooter, walking around with those dead eyes. I know you can't see my eyes; I may as well be dead. But he has the dead eyes. But he can kind of walk unobtruded and sit and have some sushi in a bar because this is that kind of place.
Not until I arrive, not until I touch down, because when I touch down, I'm going up to him and say, come on this podcast, come on this video, let's get into it. Anyway.
Never going to happen.
We'll see. Anyway, we'll move on. I want to set the scene. We always do our 3 songs, Hugh. Of this time, you pick the music to suit us through. So the 3 tunes from this period of time, which is June, July 2003, we've got Sean Paul's Get Busy, Caribbean vibe, you're in the Caribbean. Beyonce, Crazy in Love, or the sort of Evanescence, sort of rockers, sort of emo rockers, Bring Me to Life.
Where do you find
this? Is in the chart. This was the charts at this time. I'm not making this up. These were the hits. This was so we're back in 2003. We've got to pick songs from that era. We can't be picking songs from the 70s. You know.
Fair enough. Okay.
Sean Paul, Beyonce, or Evanescence?
Evanescence.
Evanescence. You know, wake me up. You know, like it was a quality song. Your kids are going to know this. Your kids are going to be like throwing chairs. You know what I mean?
My kids weren't born.
Okay, fair enough. Well, they're still going to know this song. I mean, you know,
they are connoisseurs of edgy rap music today. What I feel to kind of to stop boring clients of how do I use the share function, because I what would be fun would be bugger, like, okay, let's just go here, right? So you can see what do you see now? You see a chart.
Yeah, we see chart. We're seeing charts. Yeah. Okay, we're seeing charts. Yeah.
You're seeing the chart of Rizona, which was a Japanese bank, which we discussed the last time.
That's correct.
I had purchased it round about here, and I gave you the detail. However, I am there so that now I hope. Can you see my YouTube page?
We can see a YouTube page, yes, we can see it. And this is where you can find this video, by the way. If you're watching this, you probably know that. Sorry.
Indeed. So what's the first one? Is what? Sean Paul,
Get Busy.
Is that SH or SE?
Oh, for God. Hugh, come on, man. You're a man of the world here. SEN Paul. Sean Paul. He's like one of the biggest Caribbean pop stars in the world. He's from Jamaica.
There is no such thing as a big Caribbean pop star.
Oh, guy.
Okay, Sean.
Get Busy.
Sean Paul.
And the song's called Get Busy.
If you are listening, I really do apologize. And we are coming to the end of this section. Get
busy. That's it. That's coming up your thing. Yeah, get busy.
Oh la la. Okay, so get busy. Official video. And no doubt we'll get an advert beforehand. Is it true? I think you get paid 1,000. So Sean Paul's going to get 1,000. Oh la la. Oh la la. A negotiation. Everything in life is a negotiation, people.
Here we go.
Unless
So
you're Sean Paul.
we're just, so here we go. Hugh's loading up the video. He's getting his first look. That's Sean Paul, by the way, Hugh. I just thought I'd let you know that. See? We can't actually hear it because you've muted it on your computer, but we can see you dancing.
Okay, enough. Stop share.
Right.
Chris, I'm going to go for Sean Paul.
Okay, Sean Paul is not Beyonce, not Evanescence. So if you're in the mood, Sean Paul, Get Busy, Caribbean vibes. We're in the Caribbean. We're off and running. Now, to get onto hedge funds, that's why we're here. I want to ask you one little thing about this week. Sir Chris Hone has announced, well, not announced, it's come out through his company that he's had the biggest single payday of anyone in Britain, 345 million approximately for the last year. My question is, it's a lot of money, but last week we spoke about our friend Chase Coleman III, who made 3 billion. So why do American hedge fund people make a lot more than British hedge fund? Is there a reason?
It's why Americans have bigger cars, bigger buses, bigger trains. But it's a bigger country, Chris. You know, it's a 25 trillion or 22, 23 trillion dollar economy. It's 10 times the size of the British economy. And, you know, being big, I mean, there's it's not like being Coldplay or Sean Paul, the Caribbean's biggest export to the world of, you know, absurdity. You know, there is an infrastructure of institutional American clients which are enormous, and would have it's just easier for them to invest in an American hedge fund. It's clearly not impossible. I'm sure people who are invested in the Coleman Fund would almost certainly have Chris's fund. Let's just stick at that. It's a bigger country. The star managers just tend to manage more money. It depends on the strategy. A lot of managers, quite wisely, they you know, once you've paid yourself 3 billion, you don't necessarily, you may as well just manage your own money. But so they tend to either give money back to the clients, or they close because they're worried that the sheer volume of funds under management and the law of big numbers will begin to subtract from their performance. And the clear point about this is they, and the person that I was, do not define their character, their person, their soul via the metric of the dollar bill. Okay, they are immune or numb. It becomes like a game of Monopoly, and these numbers are simply a manifestation of winning a game. And the satisfaction of winning the game is that to record these outsized fortunes, you know, it's not by luck, it is by immense dedication and immense insight, and typically it's with immense setbacks and being able to manage those setbacks but still advance, come forward. Like the French Legion, the motto of the French Legion is "if in doubt, advance," which didn't really help if you were in Gallipoli and fighting the Turkish, and you know your general says, "Oh, tally ho, keep going." But I like that notion of do something. You know, I think we previously discussed the notion of, you know, the climber, the 2 arms. We discussed the notion of the centipede and having 100. And if I do that, I've now got three arms with the mirror. Where's the 4th? But anyway, forget. And so the centipede analogy was dealing with setbacks, because it's not a linear progression from 0 to hero. And so I keep saying Chris Coleman, I believe he was the Wales manager.
Chase Coleman the
Chase
third.
Coleman, thank you.
Yeah, Chris
Chase
Coleman was a
Coleman,
footballer. Yeah.
footballer, and then a manager
Yeah.
with some adventures. Chase Coleman's fortunes um, are not linear, and he's just managed it well. And for him, he's had some form of contentious posturing, and he has succeeded. And the money just says, "You won." Yeah. Most of these guys give this money. They give the majority of it away. I mean, do they have private jets? Do they have beautiful luxury houses? Do they stay in 5-star hotels, etc.? Yes. Do they drink Cristal, drive Ferraris, have gigantic boats, etc.? Not really. They're kind of dull, hardworking people. I mean, I guess this podcast will air this podcast around about the same time. I'm going to have an article discussing these points actually in the Daily Mail, a large British. It's not quite a tabloid. Chris, you're the journalist. What's the handle on the Daily Mail?
Yeah, I mean, it's sort of. I think it slips in. It's on the sort of. What would you say? The very shallow end of the tabloid. Tabloid with a small t. It's actually the biggest selling newspaper in Britain. It overtook the Sun. It's had reasonable. It's a lot of growth. It's doing very well to overtake the Sun, and the Sun actually now don't publish their sales figures because they don't want to be embarrassed because the Daily Mail's taken over. So yeah, and it's a very, very large website. It's one of the biggest websites in the world for terms of news as well.
Okay, so I'm going to be out there on Saturday, and really, the news this week. Chris, you had led it, like your journalist instinct had seen it coming, and we had Chase Coleman the third, and of course in the past week we had the UK equivalent through Sir Chris Hone, but at the same time that was juxtaposed with the tragic kind of findings from an inquest, which was reporting on a hedge fund manager that this time last year, as COVID came and began to rock profoundly the fundamental nature of stock markets and other risk assets. And we had, I want to say, a flash crash. We had such a rapid decline and destruction in capital. And this poor, unfortunate chap found himself losing more money than he thought was possible. And his identity was, I'm imagining, tragically, I believe it was caught up and wrapped around the losses that his clients were incurring. Remember, these are paper losses. These are not actual losses. They're only actual losses when you sell and you book the loss, and you're not like that. And so, unfortunately, this hedge fund manager committed suicide. So it shows you the highs, but of course, the lows engaged in what can be a risky business.
I mean, yeah. I mean, it was tragic to hear about that guy, and obviously we don't know him, but we obviously feel bad for him and pass on any sympathies to anyone out there that's going through something like that. But the one thing I did want to ask you was, I mean, being a hedge fund manager, is it quite a lonely position because you don't really have a boss? I mean, you are the boss. There's no one really to answer to. I know you have clients, but you're sort of the captain of the ship.
Yeah. Chief pirate. So it's like, and sticking with the analogy of the boat, you're out at sea, and typically, well, it's two scenarios. It's either you are becalmed, there's no wind, you're on a sailing boat, and typically that happens when you have recorded a loss and you're looking for markets to regain price momentum, which will allow you to rebuild positions and hopefully claw back your losses to end the year up. Typically, Sod's Law, what can happen is you find yourself becalmed in the Sea of Biscay with no wind, and running out of water and getting thirsty and thinking you're not going to make it. So that's one of the the analogies. And then the other is you're in the middle of the Atlantic and the waves are enormous, and again, and so you're trying to hold on and you're trying to get to port. You're trying to secure safe passage and deliver your calendar year gains for your clients, and of course, so that you can book and record the performance and the remuneration gain that comes from that. So I want to say, you certainly don't. You are the boss, and you've got this. I was speaking to someone yesterday about this point. You have an opponent, which is the market, and it's mendacious. It's out to get you. It doesn't want you to succeed, and it's going to throw everything at you to get you to change your mind. I don't know the names from these Greek parables or whatever, but the two sisters, these sirens that would cause sailors who would be entranced, and they would be entranced into the rocks of despair and carnage, syphilis and whatever. Sounds like a sexual disease, but and the hero would strap themselves to the mast. I will not listen. The cork in the ears. I will not listen to these sirens. I have seen the future. I have seen Jesus, the guy with the beard. It's a bruising psychological warfare. And so whilst there's maybe not a boss to report to, I mean, the clients, you're always fearful. Ever present in your mind is this notion of, I'm going to have to tell the clients. That's not fun. I mean, that's like, that's like shoplifting, God forbid, and your parents finding out. I mean, there's. Yeah. I keep coming back to this notion of shame, and shame is the lowest state of being. You never want to spend any time in the lowest state of being, but it's close to shame. So there's the client thing, which is the ultimate boss. But then you can call a friend. So there would be times, all the time, I would be in doubt, but I'd call a friend and say, hey, what do you think? Now that friend was not a stockbroker, it was not an investment bank. That friend was looking at price charts. And from time to time, I'll share my screen and we'll probably look at some of those price charts. And I felt that would give, that would talk to me, that this inanimate object would, I could conceive of a conversation. There is a wonderfully flawed investment book by Victor Niederhofer, and I am but a pale imitation of the genius of Victor. Victor was a trader for George Soros, arguably the biggest, most renowned, most respected hedge fund manager of all time, who began his fund in 1969, the year I was born. And Victor was one of the guys caught up in this Soros University, was ultimately able to manage his own hedge fund. He was a mathematical genius, and a lot of the book is given over to, arcane formula, which is way above way below my pay station, to be honest. But the book begins with him. He's carrying an enormous position, and I can't remember if he's betting on the dollar rising or falling versus the yen. Back when he was writing, I would imagine he'd be betting on typically the yen appreciates, and being Victor and being crazy, I'm sure he had the inverse. So I'm sure he was going for a dollar rise versus the Japanese currency, which we call the yen. And with these currency positions, they do not move a great deal. That's why the drama of when, again, George Soros, when he broke the Bank of England, when he forced the UK government to raise interest rates to the ludicrous level of 15%, which they held for no more than 1 or 2 hours. So crazy. And then they had to withdraw their support for the currency. And the currency, I want to say, moved 20% like that, right?
Yeah.
20%. So remember my gold shares, we've discussed the large positions that I had in the first 6 months of this fund from October 2002 to here we are in the summer of 2003. They could move on a bad day, they could move 20%, just one stock position. They could move that in a day. Whereas sterling doing that was that just never happened. It's not a black swan, but really punchy, really shocking. So Victor, in order to achieve a financial gain, would have leveraged. And again, previously we talked about the relationship with the investment or the prime brokerage bank and how they would facilitate you with lines of credit, which would allow you to leverage your returns. And more often than not, you would apply that leverage against what we call low price volatility positions. And currencies very much are these positions which they just don't move until you're like 10 times leveraged.
Yeah.
And there is a vernacular in the market. So $1 billion, a trader would call a yard. And that was always my ambition. I wanted to trade a yard of something. I think I started with Zimbabwe dollars were the easiest. Japanese yen has a lot of zeros, so you can typically trade.
So did you get on the phone? Buy a yard. That must have been quite, yeah.
Well, I would tell the guy with the phone to speak to a guy with another phone, but I would be the first one to say, yeah, but and that's buy, sell, buy yard. I think we did anyway. Victor was insane and probably had 10 yards of dollar yen, and he's under pressure. It's going against him with the leverage. Again, the mendacity of your opponent. He's being on high seas and he's not going to make it. He's bleeding P&L. The blood of his losses is dripping onto the carpet, the shag pile carpet. And he's there in front of the screen looking at the price chart and he's talking. He's having a conversation and he calls it a pet name. He's like, oh, come on, darling, please, I promise I'm never going to be as crazy as this again. Just come my way. And it's one of the best. I really relate to that. The thing that makes me think of is it's either Tim or Tom Robbins was a kind of funky kind of writer who caught my imagination back in the day. And one of my favorite novels is the story of a sock, a teaspoon, and an empty can of beans. And it's their road story across the United States. And to capture the character from inanimate objects, kind of what Victor was doing, and for sure what I was doing. I didn't talk to people. I talked to my risk positions, and I always promised I would never be as dumb or crazy again until of course I was.
I mean, I think that's what's great about doing this, and people listening. There is quite a lot of literature out there that they can get, and I think being a hedge fund manager is not just pouring through spreadsheets of numbers. Okay, there obviously is a side of that, but there is a greater narrative that you can lay on top of that, and it's only once someone like you would create the narrative, you'd create the insight, and then you would maybe look at the numbers, or you'd get someone else to look at numbers and report back to you. But you weren't driven by a spreadsheet, which I think a lot of people miss that. It's an adventure in a lot of ways if you approach it from that mindset.
Yeah, the adventure capitalist, and Victor's worth it. I can't end any conversation about Victor without. So it didn't end well for Victor because he truly was completely bonkers. But you have to listen to the crazy people, and for sure he has some amazing insights. But so where are we? Let's get back into character, Chris. We are in June of 2003.
Yep.
Now, if we were to go back 5 years ago, that would take us to 1998.
Yep.
Let's go back 6 to 1997 to be sure. And at that point, there was this acronym which was the Tigers, the Tiger economies, and macro investing.
Thailand,
yeah.
India.
No, that came later. Southeast Asia. So
what's the I for?
Oh no! Oh, actually, Tiger just was more a reference to their vibrancy.
I've embarrassed myself.
Because
BRIC was one, was it not? Brazil, Russia, India, China. Was that not one for a while? Right. Okay.
That was conceived by a partner at Goldman Sachs, which was became just really, really annoying. But Tiger was more like prancing. These things were growing. So Thailand is an example. Thailand, as an example, was and possibly holds the modern record for the fastest rate of economic expansion over, let's call it 15 years. It just grew at from a very low base, but it's such an enormously fast clip. Possibly it's growing at close on 10% per annum for 15 years. That's really amazing. And what happens is that success begets more success because everyone wants to participate and share. And so people are plowing. It's called foreign direct investment. They want to build factories, etc. But then dullards like me, we come in and like, hey, we just want to put speculative funds into this wonder economy because the currency begins to rise as there are more buyers than sellers. And again, George Soros and a group of other elite managers were able to recognize that below the surface, if you were to do the homework, if you were to pursue a macro understanding, which again you get from books, Kindleberger, manias, panics, etc. This is a book by this, I think he was a Harvard professor, sadly passed away about 5 years ago. This book is the Bible of global macro investing. It's an astonishing book. But for all of that, actually, if you had pursued it rigorously or vigorously for the last 10 years, you would not be running a hedge fund. So the world's kind of changed. We can come back to that at a later stage. I think we will touch upon that because I'm going to talk about central banks later.
It's good. Well, we can talk about that because it's quite interesting. Yeah. Obviously, the Bank of England right now is run by a former hedge fund manager or chancellor. Was a hedge fund manager, wasn't he?
And to complete the loop, he was an investment analyst for Chris Hohen.
Yeah. So all comes round. It all comes round. So Hugh, that means you could be the central banker somewhere, Hugh. We can see you've been taken over as the central banker.
They should put me in charge.
Yeah, I think so.
You need the crazy. We've had too many suits, too many conservative people, and too much nonsense. And the principal role of a central bank is to change expectations, to change narratives, and a lot of it works on smoke and mirrors. Like I made the analogy with Dorothy and the Wizard of Oz, and when you peek behind the curtain, you put the mystique and the propaganda is that they are omnipotent. Don't fight the Fed. These are the authorities are very happy to propagate this nonsense. The reality is very, very different. And the challenge for these communities of central bankers today is that more and more the curtain is being pulled back to reveal the truth that they really do not know what they're doing. And so the banking community is more and more less impressed or less fearful of the consequences of fighting with these guys. And that's why, actually, truth be told, I would put a kind of crazy person like me, I would like really shake it up. And I would do so in order to play a game of poker with the banks, because a central bank is trying to dictate and influence one and only one investment decision. A bank, not a hedge fund, but a bank has only one decision to make. how much of its capital it allocates to, let's call it commercially risk-free investments. And that is called lending to the government, as opposed to taking on commercial risk and lending to you and I and small businesses and large businesses. Okay, so public versus private. And ever since the crash of 2008, the commercial banking system globally has been mindful to take less and less risk. And that decision is robbing the global economy of, let's call it an elbow grease or an oxygen, but of some key ingredient which is necessary to foster economic growth and to create the prosperity which we need to recover from this like war-ravaged COVID landscape that we find ourselves in. So because the banks are less fearful of the central bank, because the central bank keeps saying, I'm going to blow your house down with inflation, you know, because what they're saying is, hey, listen, we're printing money. So for instance, in the month of March, so here we are, March 2021. In the month of March 2020, the American central bank printed dollars. They printed 20% of all the dollars that ever been printed ever in the history of America were printed 1 year ago.
That's astonishing. That's astonishing, isn't it? Yeah.
And this is the reason why Bitcoin has been flying, etc. And so if you're sitting there and you're a bank and your big bet is to own government bonds, that's kind of a scary thing, because that would, from an orthodox understanding, and again, if we were to take in the genius of a Charles Kinderberger, that the supposition you would have would be time to get out of Dodge City, time to move from these commercially safe investments to the Wild West and the frontier. And there's a bit of that going on this year. Government bonds have backed off, which is to say their prices has fallen, and for them it's fallen quite rapidly. But by and large, banks are like, nah, don't believe you. You're just messing with us. Don't believe you. Whereas I think if it was me, and I was printing that money, I think they'd be going, shit.
Yeah,
It's a game of expectation. But finally, on Victor Niederhoff, these great macro minds could see that, to quote the French rap singer Orelsan, La fête est finie, that the party for these prancing tiger economies that only ever expanded from 1997 onwards. Managers like me started taking enormous bets to say, this is smoke and mirrors, this is a charade, you guys are bust. And of course, the popular opinion, and you get a Nobel economist. You can buy Nobel economists. It's outrageous. You know, genius for sale. Watch
Hugh's
it on BBC.
Hughes had a wee bit of in his previous, not your previous life, but when you were actually still a hedge fund manager, you had a famous joust on the BBC with a Nobel Prize winner, Joseph Stiglitz, didn't you? I think you told him, look,
Stiglitz, yeah, Krugman, yeah.
Look, mate, can I introduce you to the real world or something? Or can I bring you back to the real world? I can't remember the exact phrase.
Welcome to the real world, you
yes.
mother. And you know, he got off so damn right. I've watched that a few times now, and I am unrecognizable. My hair is short.
He's in a suit as well.
Which seems almost to be too big for me, despite it being, believe me, very expensive and tailored. But
where was it from? Do you know where that suit was from? Do we know? No.
I think Ralph Lauren.
Oh, but nice.
The Purple Room Ralph Lauren. Actually, no, that's not true. There was a bespoke tailor's which opened up, would you believe, almost on the opposite side of the street to one of London's biggest, most sober, best hedge funds. Lansdowne, actually, let's name them. An amazing, really good stable. Really conservative guys, but across the road there was a guy hey, get your suit here. No. Anyway, I got my suit. Pogson. And actually, do you know, there's the chap was Scottish. Can't recall his Christian name, but Pogson or Podson. Anyway, haven't thought of it for a long time. Anyway, so when Soros was putting billions and billions at work, speculatively fighting the central banks in Southeast Asia, he sent Agent Victor Niederhofer. And Victor, he did two things, two parts of his analysis. Time is maybe going to exaggerate this story, but he would count the number of cigarette butts, fag butts, on the street. He would walk down a major street in Bangkok, maybe 1, 2, 3, 4, 5, 6, and he did that monthly. And his view was that when all the money's flowing in, you feel rich. You know, and also he would how much of it was butt and how much
was left. Yeah, if they could afford to throw a quarter away, they must be wealthy, or they must be affluent.
This and he never wore shoes. I don't know if that was just in the office, but you'd be walking down and be like, okay, with the measuring, okay, right, okay. And he did this month on month, and he created charts, and that was one of his techniques. And the other one was visiting and studying the brothels of Southeast Asia, and he had a theory about venereal disease and prosperity. Just a legend.
Oh, great. Well, we'll bring you back into 2003, but it's quite interesting we're talking about central bankers here, because obviously these 2 months we left off May. Hugh, you were nailing it, you were on fire, you were doing really well. But one thing about this I don't think we really touched on is that, you know, gold's a big thing for you at this point in your career. And central bank, the Bank of England, the British central bank, they were getting rid of all their gold, weren't they? So guys like you were quite happily taking it, but it wasn't just Britain, other central banks were getting it as well. So I don't think we really mentioned that last time. I think we just mentioned you sort of investing in mining companies, but all these central banks were not seeing what you were seeing, which kind of ties into what we're saying a little bit. Maybe they're not always, well, they don't see what you guys see, or some of you see anyway.
Yeah, for sure. Let me stop sharing a second. So gold, unlike Bitcoin's been around for this is the 13th year of existence. Gold has been around. Gold defines civilization, if you will. Gold is made by God. The genius of God is he's a sloth. He can't be bothered making too much gold. And so it's always is rare, it's a precious, it's a Birkin handbag if you're a lady. It's a special Swiss watch if you're a guy. It's God's Swiss watch, gold. And it had always been a store of value. And again, why? For exactly the point that we touched upon earlier, this amazing statistic that the central bank last year in 1 month produced 20% of all the dollars they'd ever printed in the history of the world was in 1 month last year. And so it's that abundance of paper money, which we call fiat. Fiat it kind of goes back to the fiefdoms of kings, and they would issue on their orders, they would issue gold coins. And then when no one was looking, they would start taking the gold. They would look gold by appearance, but as time went on and they mounted preposterous military and disastrous military campaigns, and they needed money to pay the soldiers and the logistics, they would take the gold out of the coins. And so over time, money became fiat, which is to say it was like a cult. It has the investiture of our stamp of confidence, but it has no tangible value. And so from time to time, people like us, we lose faith in the elders, in the authorities who are supposed to be, who are supposed to be looking after us and preserving the integrity of the economy, preserving our wealth. And there are times where the they produce too much paper money. And so you want instead to not have your money in the bank earning zero. You want to hold it in gold earning zero, but relatively the value of gold goes up the more that its supply is held constant, whereas the supply of paper money is accelerating. So gold had, I don't know, 5,000 years of demonstrating this innate defensive and robust ability to protect capital or wealth. And it really came into vogue during the decade of the 1970s, because that's when you had our Arab friends created OPEC, and you had Arab wars with Israel. The US and the West were deemed to be allies of Israel, and so the Arabs had an embargo on oil, which forced the price of petrol and cars to the moon, and as governments try to be COVID-like in their kind of protecting the economy, they overdid it. And the decade of the 70s was marred by lots of price inflation. And so the smart people allocated early in that decade, you could buy gold for 30. Gold had been fixed, and it was determined by governments that it should never trade, but they took the handbrake off in 1970 or 71. You could buy financial futures, which is to say you didn't even have to own gold. Owning gold is cumbersome. You need a bank vault. They're heavy, they're big. But when you can buy a financial future, suddenly it's something you can buy or sell like a cup of coffee, cup of joe. Anyway, it had sat at $35 per ounce of gold for, let's say, at least 30 years. And that was the wrong price. And by the end of that decade, and I think we touched upon this previously, we touched upon how the Japanese stock market almost high touched. The highest point for the Japanese stock market was the very last day of the 1980s.
Yeah, we talked about that, yeah.
And the high touch for the NASDAQ and this great technology boom and bust was actually 3 months later. It was March 2000. So decades are kind of scary places, new message to self, because we've just completed the decade of 2010 to 2020, or maybe we're at the end of that decade this year. No, well, yeah, we have completed.
No, yeah, completed, yeah.
And strange things happen round about those. I mean, again, this is nonsense, but having said that, I'm thinking, interesting. A point to note. But gold went from $35 and it almost high-ticked, I want to say, at $820 in January of 1980. It peaked with the disastrous American intervention to free, or to attempt to free, their hostages from the Iranian embassy. And it never saw that price again. So that was January 1980. And here we are in 2003. So we are 23 years later, and gold has only gone down. And gold in this period was trading somewhere around the high 200s, the low 300s. So almost a third of the value that it traded 23 years ago. And that's the point where that's the point where Gordon Brown and the Bank of England, they decide to panic at the bottom and not when it's trading at the high. Again, all of us have these mendacious opponents. The markets are always trying to encourage you to do the damn silliest thing. And
how can they see the exact opposite from you guys? Because you obviously are buying it knowing that, or not knowing, but high chance it's going to go up, which we've shown in your results of this year. It does go up. Clearly, you're making great results. How can they not see that? Or why can they not see that?
Two things. To be honest, to be fair to them, they are not remunerated to be curious. Their task is not to accrue speculative gains for other people. Their task is probity. Their task is to sail the ship through the storm, to be the last man standing. So it's not in their brief. And secondly, they're not paid in the manner that, so, I mean, that's one and the same thing. It's just not their brief. But
it seems crazy to sell like essentially their citizens' wealth off because it's belonging to the country to you or someone like you, and then we see that you're making huge amounts of money, and as we go on, I mean, what did it go up to? Went up to like, I don't know, like 10 times the value what you bought it for. I mean, it was crazy.
It's got pretty close to 2,000 in the last year. I don't think it's touched 2,000. Pretty close. And it bottomed at about 250 or so. They would have been selling around about those levels, and they were buying it back at 800, 900, 1,000, 1,100, but that's not their job. My job was to be the provocateur. My job was, when everyone said that's impossible, who would possibly conceive of that? That was my role.
But if I'm a central banker, right, and I'm seeing someone like you buying this, and I'm thinking, right, the people like you, they make money based on their returns. So they clearly think there's something. Why are they buying our gold? Like, it's when you don't sell someone your old socks. No one's going to buy your old socks because there's no value. But if someone is buying your old socks, you start to think, well, hold on a minute here. Am I not missing something? Does that? That seems very, from a non-financial person, it doesn't seem to make sense to me. But I hear what you're saying.
No. Well, the instigated more curiosity in their fiduciary kind of discovery process as the decade wore on, and I think it was after the shock of the stock market and banking collapse of 2008. And again, if you remember, that was a very good year for me. I had seen it, but it was the crazy people again who had seen it and who had warned about it and who had been dismissed as cranks. And thereafter, the Bank of England began to send kind of young, I think they were really just trainees, but they had a market supervision department that would come, and I certainly had meetings with them once or twice a year. And it was like, hey, actually, we're listening. We want to hear this. We're trying to.
So they learned from that. Okay,
yeah.
So they learned from that. So they came in. They came in. Okay, I see. All right.
But I
anyway.
promise, Chris. But I promise you, they probably did that for a year, maybe 2 years, and then they get fed up of it. And
they don't keep doing it. They go back to the old way. Anyway, okay. So we're in June 2003, and I think you'll hopefully share a screen with us. So if you're listening on audio, apologies, but for the people on YouTube, you're now going to get a look at the monthly from June 2003, and shock horror. Hugh Hendry, the man who built his reputation on being unorthodox and uncorrelated to the market, is exactly in line with the market this month. 1.9%. Oh no, sorry, you're not. I apologies. No. I'm talking rubbish. Sorry, take that back. I take that back. I'm looking at the wrong figures. 1.9, and the market does 3.29. But correct. For the last 3 months, I mean, he's on a real roll. You're up pretty much 30%, and the FTSE 100's up, say, 13%. So you're really on at the moment. I mean, it's still doing well. There's a small dip here, but I mean, things are really going your way at the moment.
And for the year to date, up 19 with the equity market down 2.5%, and from the inception back in October of 2002, up the best part of 14, and again the market down. So if you remember, the brief is to not lose money, yep, and to be uncorrelated. And so the uncorrelated typically means, hey, look, make money when no one else is making money, and when everyone's making money, try and not lose too much. That was the brief. Okay. So, and I think the previous month, I think I was up 15% or something crazy.
16, I think, actually. But anyway,
16, there you go. What you find, what we will discover as this process continues is that the quality and the insights of the investment letters are the inverse of the portfolio performance, which is to say, the portfolio performance of 2003 was exceptional. I don't spoil it alert, but I made 50% for the year. But when I look back at those investment reports, they are mediocre. Now, and actually, because remember, I just come off this, I had $100 million fund, and in February I'd borrowed 100 to buy more. So I purchased 200 million largely of gold stocks. I then went, oh my God, I'm dying, because they then had this there was a momentary disturbance in my universe. And
an air pocket.
An air pocket. And I went, expletive. And like I said before, heroes dig shallow graves or shallower graves. And so just as they were burying me, I was like, I didn't go down too far. And then when the air pocket had passed, I then said, again, almost like zero memory of you. So I love you. I'm sorry I never met you, and and I'm not interested. And now I love you again.
Yeah, straight back in. Yeah.
And now not only do I love you, I want to take you to a very expensive restaurant, very expensive hotel. We're going to spend the rest of our life together. So I've spent in and out. I've traded $600 million, 6 times the fund's value, enriched the investment banks, funded magnums of Cristal champagne for the trading class community. And so when it came to writing letters, I'm like, I can't be asked. And so I'm pretty sure that this letter, and indeed the next one, are written by Crispin.
That's Crispin Odey. Crispin Odey, who took, Hugh met Crispin Odey, a bit of a sort of, I guess, a mentor to you in some ways. Started you off in the hedge fund game, and obviously then you got your own hedge fund. So, but at this time you were sort of under his banner, under his regulatory banner at some point, weren't you? So hence maybe why he'd be writing this. Yeah.
Yeah, and that's why the fund is called the Odey Eclectica Fund. So we were both running global macro funds. I was a kind of, the whip snapper. What's that expression? Whip snapper?
Yeah, the whip snapper. Yeah.
I was the kind of.
Well, he was a sorcerer. You were the apprentice. No, is that a way of looking at it?
I was the weird love child of the weird Frankenstein love child of Crispin Odey. What a grotesque thought that is.
But you were running your own fund. I mean, when you say Eclectica, that was you. You're making decisions. I mean, people shouldn't get it confused that you were doing. It was your fund. You were in charge, and he had his part. He had his fund. But don't get the names mixed up. It wasn't that he was overseeing this. It's just a kind of regulatory name thing. It doesn't really matter. Yeah, it's just a bit of administration, really.
Yeah, and so if I couldn't be asked, at least he was always writing something, so we just cut and paste his. Because I think I was at the beach. I was like, guys, I am knackered. This has been tough,
Do hedge fund managers write this, or do you dictate this to a secretary or an assistant, or do you actually sit and write to hedge fund managers?
This comes from the soul. This is the real thing.
So this is written by the hedge fund manager. They're sitting at their word processor or the computer. They're not dictating this to an assistant down the phone or something like that.
Crispin would be writing this with a fountain pen and some expensive paper.
Right. Okay.
Probably in his dressing gown and naked. But anyway,
and what about you? Would you write yours when you did write them? When you personally wrote them? Would you write them, or would you dictate them, or how would you do it?
No, I wrote it on the computer. Okay. I put it off as long as possible. So the June report, I bet you I wrote the June report on the 29th or the 30th of June. I waited till the very last minute. I kept putting it off, but I did find that it made me a better writer when I was like, I'm a stress bunny. You've got to create stress to bring out the best in me. Go figure. I've chosen a path more arduous than perhaps is necessary. So anyway, I read this in preparation for our discussion last night, and Chris got a lot of good things, a lot of things right, and made a lot of colorful insights that made me and other people think this, I'm sure he would agree, is not his finest hour. And he's not here to defend himself, so I'm not going to take it too far. But I've read this over and over again, and just doesn't make sense. And I think it's just best to move on. The Kanaden, however, we have a stock insight. And the last time around, we had a Japanese stock insight. And in fact, this time around, we saw it when I was sharing my screen. But here, this Kanaden. So I wrote this. I'm giving it my name on the podcast. Let's talk about the work that I was doing, because this is quirky me. Kanaden. There's a great quote which I must try and dig up. I sent it to you last night in an article about Guy Hans and his takeover EMI, and
yeah.
I'm sure we might touch upon that. And which ultimately bit Guy's big ass enormously. It was a failure. He financed it with debt just as the storms of 2008 were set to be unleashed, and he lost that business, and I'd been involved in it. But there is a kind of a hubristic comment where he was saying, we really, really like terrible businesses, really, really bad, shocking bad businesses. And the great thing is, in taking over EMI, we've discovered that it was even worse than we thought. We thought it was really, really shitty. And we all come to say things which we come to regret. And of course, he was unable. He would have been vindicated, but he never got to last the course. And this is the problem with leverage. It's not a linear point A to point B. You have to imagine the tortured path. We've talked about Jesus with the apostles in the Garden of Nazareth, and you've got to navigate the cock crowing 3 times. It will always crow 3 times to mark the fact that your mendacious opponent, this market, has tested your resolve. It's not a function of seeing the future, it's staying on the path, regardless. But so Kanaden is interesting because it is the manifestation of mediocrity. This is
what is Kanaden? I think for people who don't know, can you fill us in what the business was and what sort of attracted you to it?
I can indeed. Can I tell you what its business was? No, I have no idea. Let me read you the description. But I mean, candidly, I didn't really care. Did I visit this company? Did I speak to their management? Did I speak to a knowledgeable stockbroker? No. So what did I say it does? Sales, and so it's a company with, at the time, it had $1 billion, let's see, $1,000 million of revenue. So,
yeah,
that's something. And in the paper, I say, listen, I have doubts over the quality of this business. My best guess is that this is a profoundly mediocre business. And it was an affiliate, and it still is, it's around today, it's an affiliate of Mitsubishi Electric, which is one of these giant industrial concerns in Japan.
So it may make parts or components. We might have actually come across Kanaden products without knowing it, and devices. You
would never know. So it sells electronic components and industrial machines, and it says computers. Really, I can't believe they did computers. And what I write, I say, I am willing to buy even the lousiest companies. So here I am, a bit like Guy Hans, at valuations such as these. If only, and I'm saying, oh, if only I could find some of these valuations closer to home. So what am I getting at? Because I gave a historical insight into. I hope many of us have heard of John Maynard Keynes, the economist, celebrated economist from the 1920s, 1930s, 1940s, and a great mind. And what people tend not to know is that he was also an amazing investor, and he looked after the endowment funds of some colleges, I think at Cambridge. And his form of investing, again, he wasn't quite Victor Niederhoff, but he would commit the morning to lying in bed, and he would have he would have boiled eggs on a tray with little toast soldiers to dip in his eggs. The maid would provide the London Times, and with the Financial Times and all the prices. And he was investing on the metric of what we call the price to sales. And what I mean by that is, in this example of Kanaden, I said to you they had $1,000 million of revenue, and they, year in, year out, they made that. And Keynes chose to focus on revenue as opposed to profits, because the orthodoxy is you define the valuation of stocks using this metric of price to earnings. So you divide how much it would cost you to buy the entirety of the business, and you divide that by 1 year's earnings. And that's a standard metric for discussing valuation. And Keynes had the insight, which was back in the 1930s, there were no profits. We had an economic depression.
Uh-huh.
And so that was relevant because, again, we gave mention in the previous podcast to Japan having been superhuman in terms of its economic expansion in the 1980s. It high-ticked in 1989. So 1989 today is what, 21 years ago. And whilst its economy has expanded just a tiny little bit, it's almost flat. It has not enjoyed the degree of economic growth and prosperity that it's become accustomed to. And so trying to find profits and using profits as the barometer to gauge whether something was a good buy or not seems a little bit off-piste. And so Keynes was buying steel companies and cyclical businesses, and he was buying them on prices of between 1% and 3% of revenue. It's a famous observation that you could buy hotels in New York in 1935, and the revenue from the bar would exceed what you'd be asked to pay for the entirety of the hotel. Price to sales is an interesting observation. So Kanaden, this obscure Japanese company, you could buy the entire business for 30 million. So 1,000 million of sales, and you could buy 1,000 million, you could buy the right to own something, making $1 billion of sales every year for 30 million. And that is, I was amazed. And I get to be GMK, I get to be Keynes. And so we bought it on this metric of 3% of sales. And normally, even the lousiest business should be able to generate, depending on how much capital is necessary. You know, if you need to build factories, etc., then you've got to put a lot of capital expenditure. There are some distribution businesses which don't require that, and they can survive on 3% margins. But typically find that 50% of sales, between 30 and 50% of sales is where the majority of mediocre, low margin businesses trade. And this was trading on 3. It was trading on 90% less than the bottom of the range that I articulated to you. And I bought some. Now, if this was Blue Peter, which is this famous children's show from back in my time, I don't think it's no longer shown.
No, it's still on. It's still on. No, it's still on. You still get you still get the Blue Peter gold badge if you do something spectacular. Yeah, it's still around.
Well, I reckon I deserved a blue badge for Mr. Kanaden. Chris, you can see the.
I can see it. Yeah, we can see it. We've got the chart. We've got the monthly back up on screen for people listening on YouTube. Obviously, you can see it.
Yeah, and.
But it's great when you say we are prepared to buy even lousy companies. I just imagine some of your investors that have given you like 50 million or 100 million sort of spitting out their breakfast as their hedge fund manager tells them you're buying lousy companies. That's a pretty cool way of putting it.
I was never shy from being candid. Whether it was wise is another question. Now, are we back to our Sean Paul and his? Yeah,
we're back to Sean Paul. We're back to Sean Paul. You're educating yourself on the Jamaican dancehall scene.
Oh la la! Oops. Because I'm trying to find my email. I asked my so this was actually this is also because this was the bank that we discussed the previous month, and we're looking at the price chart of the bank Rezona. And
no, we're looking at Sean Paul at the moment. Maybe you're looking at that, but we're looking at Sean Paul.
Thank you for that.
We're looking at it's just still of Sean Paul. Who, if people are joining us late, you missed the confusion at the start. Hugh had to look up who Sean Paul was.
I imagine Hugh, on behalf of everyone listening, had to look up.
No, honestly, you just after you got off this call, phone your kids, phone your wife. They're going to know who Sean Paul is. No one's going to know who, a lot of the stuff you're talking about is like, these people in the investment. Depends what the audience is here, but anyway, moving on.
I'm worried people think I'm bald. I'm going to take my hat off and I'm getting.
People think you're Bono.
Yeah. Now, I do believe you can see the price chart.
Yes, we can see the price chart. Yes, we can.
And the more observant of you might have just seen that I got a price alert. Let's hold that thought. There was a price alert, so I use, and again, this is something we may explore in future. But I can turn you into. I can share some of my investment techniques that we can actually. Chris, can you confirm you can see the price chart there?
Yeah, and
it's not Sean Paul.
No, so we can see the price chart. Bank. We can see the price chart. Yes, Rezona Holdings.
You can see my cursor.
Yeah.
Okay, thank you. And this is a snapshot probably taken from a Bloomberg terminal, but you can recreate these with free websites, and I tend to use bar charts, and we could all. There's no subscription to it. I could. From time to time, I think I'm going to delve into bar charts and explain more of what I was doing. But anyway, I bought Rezona on a similar bit the month before, and 2000. This is 2003. So with great fortune and insight, we got to participate in Rezona going up 10 times. That's kind of what you do, being the contentious kind of guy. And I use that same price to sales methodology. And for me, the metric that I use for banks are complicated. There's a lot of moving parts. And I like to keep it simple. And so I wanted to know the market cap so that the equity valuation, if you take all of the shares outstanding and you multiply by the market price, that would give you the equity capitalization, the market value, okay? And I would divide that by the totality of loans outstanding, because banks make money from lending you. That's it's a liability because there's a danger you don't repay, but because it's a risk activity, you pay the bank a spread and a profit margin, and so
you pay an interest rate basically to the bank.
You pay an interest rate, and that interest rate represents the profits of the bank,
Yeah.
or the gross profits of the bank. And so back in the day, I want to say this was trading on, the market capitalization was only 5% of total loans. And to put that in comparison, today, I think JP Morgan trades on 50% of loans outstanding. So it was trading on a tenth of that metric with regard to JP Morgan today. Now I'm going to, oh my God, do I dare click on my email? I'm going to dare, Chris, I'm going to dare. So now you can see my emails, yeah? Or are you still looking at the chart?
No, we're now scanning to see if we can get any celebrity email addresses or anything cool that we can send like an email to someone. That's what I'm doing. I don't know everybody at home.
Oh, I'm reopening Outlook. As you all can tell, I'm not okay. So my wonderful ex-colleague,
here we go,
has very kindly shared me the chart. So this is Kanaden, back to our lousy business, and this is 1997. So here we are, and of course, I hope there's a pattern that we're beginning to recognize, that there's a long bear market. It's fallen from 500, and I'm buying it at 200 or thereabouts. Yeah.
Yep, we see that.
And so we're talking. This is the midpoint of 2003, and I'm buying it. Prices probably about 280, and it doubles it was a doubler for me. And then George, my colleague, this is a lousy business, Chris, but bought at a magnificent price. So here we are, purchased it here, it doubles, it then reverses because it really is mediocre. And the Japanese stock market has been in the tank for 25 years. And look at it now, it's trading 6 times above the price, and actually it looks a buy. Kanaden from looking at that, I want to say that Kanaden is a butterfly. It's gone from a grubby caterpillar, and it looks as if it's going to become, it obviously has captured some form of electronics, be it, and I am surmising, maybe it's got something to do with green technology or the circuitry that you need for electric vehicles. But something here tells me that the business fortunes of this company has changed. And the point where you really had to buy this business was this point here at the end of 2013, when it took out this absolute price high, and you began to share the company of strangers who were willing to participate in the opaque. We haven't seen the future, but increasingly, because we take out this 10-year price high, what it's telling you is that someone knows this company. Someone is seeing something a lot better than they're accustomed to, and someone is willing to pay new price highs. And you should always get interested in stocks at that point.
So I mean, you've seen this chart, you can see all that. But if you had been, so 2013, 14, 15, that's when you would have really jumped on this if this had been something you were looking at. But it's amazing how much you can see from a chart. It's almost like, I think we've discussed it before, to you, it's almost like someone's, like a human's vitals, heartbeat and pulse and all that. You can really see a lot from a chart that other people can't,
Yeah, the doctor coming, and if you have the misfortune to be in a hospital, I mean, most unlikely. I mean, the only people who visit hospitals today are people with respiratory problems and COVID. Everyone else has been excluded. Anyway, we'll go without comment. But yeah, the doctor passes to determine the health and the vitality of the client, of the patient, and that's kind of what I could do. My patients were in the casualty ward. They were the fallen angels. They were the cheap, lousy businesses that no one wanted. So I want to say that is a skill set, and that's something that I hope I can share as we pass on.
By the time we get to like 2015 in this journey, we will have mastered the technology of what the hell we're doing.
I feel I'm getting better.
Yeah, okay. Well, we're getting there. We're getting there. So
not super hot, but
okay. So
no.
this is July as well, and this is the second month. And I think what Hugh was saying, this is quite a long episode, but a lot of what he was saying sort of ties into this month as well, doesn't it? There's a sort of your general strategy across this period of time is the same.
Absolutely. Field reports, 2003, and so we want to take a glimpse at August, but August was another.
We can see July, but can you zoom us out of July, because we can't actually see the full. We're sort of very high. We're zoomed in just on the top. We can't actually see any numbers on July. Here we go. Okay.
There's August.
Can we see July? What about July? We've missed July out.
We did July.
No,
July
we did.
Was Kanaden.
No, July was June.
Oh my God. Okay, no. So we're done. We'll do July next time. It's way too long.
Okay, Hugh's taking a strop here. Hugh's done a diva move on us. That's it, people. That's it.
I'm the edge, and I'm coming in. I'm like, Bono, shut up.
You're Bono. I'm the edge here. You're Bono.
Okay, Bono, play them blues, Bono, because I want to show you. I think it's important, and I do think we have to wrap. But
okay, so that's June done, and we'll carry on with July next
exactly.
time. But before we go, Hugh's got a wee bonus piece for us here.
Exactly, because as we were speaking, I got that price chart, and it's a price chart alert. So I am trying to find. Okay, here we go. So I'm sharing again my email and bar chart. Okay. And every time I seem to double click, it wants to reopen. Oh, bugger, there. So your alert for gold has been triggered. It has gone below 1,700. So why did I have a price? So let's go back to my barchart.com. You can see that I'm in a website now, Chris, barchart.com. I am not paid or sponsoring this website. It's just something I randomly found, and I like its basic functionality.
But if they wish to pay me, feel free.
Absolutely.
Yeah.
And so now I'm navigating my watch list. So those of you who can pause, you can see kind of all the stocks which I either own or I have a curiosity surrounding. And that's silver and and Edge, play the blues.
You want me to, Hugh, for anyone that can't see this, Hugh's sort of, we're scrolling through a lot of different stocks. We see Coca-Cola, Ericsson.
Oh, you don't see Coca. You see a bottler for Coca-Cola. I know the family. Let me.
All right, Coca-Cola European Partners. Sorry, I see them, and we see now he's looking up gold.
Okay. Yeah. So it was gold. Gold was the one that registered, and so I'm getting a signal as the doctor. I'm getting a signal which is a concern. So yeah. Actually, it's not a concern. I was looking at this a few days ago and I said, hey, listen, it's like call a friend. Call me, send me an email if the price goes below 1,700, which was this level, because I'm now interested. So it has gone below 1,700. And if you're listening on podcast, we're looking at an uptrend in the price of gold, which is the last 2 years. And I've put a trend channel, which is capturing the uptrend, and gold has had a reversal. So gold, actually, we mentioned this earlier, it actually traded above 2,000 for the first time ever in August of last year. But since then, it has reversed now by 3 points. So it's fallen 15%. Now, for me, in my chart reading, this is a level where we're now back to the upper trend boundary. And so this is a position where you become curious about gold. If gold were just to continue to fall and to trade to 1,300, the story is over. Gold would have no relevancy. However, I would begin to amass and start taking position again in gold shares at around, or in gold, rather, gold futures, around the 1700 level. But I tell you, because I'm against a mendacious opponent that doesn't want me to succeed, I would, let's say, I've got 100 units of gold I want to allocate. Today, I would use 25 units of that, because I think people are always nervous and they will have stop losses. And if we go below this level of 1670, people will have automatic stops and they will close their risk position. So the market knows that, and it knows if you can get to that level, people are going to volunteer to sell. And so that's a good position for you to be buying. So I would estimate that gold might touch 1600, and at 1600, I would want to buy another 50 units. So now I purchased 25 and 50. So I've purchased 75%, and I'd have another 25, which would be speculative in case we got to 1550. So madness, but all about creating a narrative, this is what I would do, writing it down just in case it happens, because then you know what to do.
And I think that was really good for people to see there, because that's actually a bit of real time. You know, that was you back in hedge fund manager mode there. Really, that is what you would be doing on a day-to-day basis, not just on gold but on everything. So it was pretty cool. People saw that. We went on maybe a bit longer, but we did June very thoroughly, and we got a lot of backstory, and we will continue the journey next week in July. So all that remains for me to say is goodbye, good luck, take care of yourself, and Bono, would you like to sing us out?
I listened to you two running on the beach, and I can't think of anything, which is shocking. Sunday, bloody Sunday. I always prefer Ferris Bueller, that wonderful movie, and he's in the shower and he's like, I recall Central Park and Fall, how you tore your dress. What a mess. Chris, goodbye. Thank you, everyone. Very intelligent episode this week.
Goodbye.